Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Pederson.
Thank you for joining the Real Estate Risk Report. I'm your host, as always, Lance Pederson. So today I have two good friends of mine on the show here, Ruben and Andrew with Wieland. How you doing, guys?
Awesome. It's awesome. Thank you so much for having us. It's a pleasure.
Yeah, no, I'm super excited to have you. So the three of us tend to have, when we get together, it's usually the three of us and we're on Zoom and we have these very in-depth strategic discussions about business and lending and funds and, stuff that we nerd out on. So excited to have these guys on and sort of share with the rest of you, the types of things that we tend to talk about, which I think are important things.
And it's always fun. It's always fun.
Always fun. Yep. We always have a good time. So why don't we, before we kind of get into it, I always like to get a bit of background, how people sort of, got into this business and what attracted them to it. So Ruben, maybe why don't you share a little bit with us sort of how you got into the real estate biz and private lending and, sort of get us up to speed, and we'll talk a little bit more about, what you guys are doing at Wieland here in a minute, but I'd like to kind of get the background first.
Of course. So, the way in which we got into real estate was kind of, I would say, coincidental. My brother owned a pizzeria out in Brooklyn, small restaurant, ended up selling it successfully and then moved over to Florida, specifically Palm Coast. So it was the north part of Florida, buying raw land, developing on it, single units, 2 units and so on. And then that kind of morphed into not only Florida, but into New York. We were buying, selling, flipping, developing, wholesaling, a little bit of everything, whatever came our way and whatever made sense. And then eventually, right after law school, one of the founding partners, Moses, and I, we decided to head out to one of the hard money conferences for purposes of finding a cheaper source of capital for our own projects. Mm-hmm. Went in there thinking that we're gonna leave with finding cheaper source, and then left as hard money lenders. That was in 2018, March of 2018. In April of 2018, we wrote our first loan. So it all kind of happened. It wasn't planned specifically on the private lending side. It was not planned. It was more or less like a side gig, and just to see if this is going to work while we're still doing our own projects here in New York. And it blew up. I mean, it really bloomed into a business that it has way surpassed what we were expecting and what we were predicting. And we're definitely on the right tracks, for big things.
Yeah, no, that's great. And it is interesting. I mean, a lot of guys who were in the trenches, developing and buying and selling, and they end up becoming really great lenders. I think of another group that's kind of in your neck of the woods. He's quite the character, but Billy Procida with Procida Funding. I mean, him and his family, they were big time developers and whatever, but it's made him a great lender, right? In fact, I think a lot of times because you realize it's that partnership and relationship with the borrowers. You've walked 1,000 miles in their shoes, and you know how they tick, how they think. And at the end of the day, it is money and it's fungible, right? I mean, and as you said, you guys yourselves made the Mecca you made the trip out to the Mecca that is the private lending conference circuit or whatever, and looking in the search for cheap money, right? And you leave sort of lenders or whatever. So but it does make a lot of sense. And conversely, you see some guys that go the other direction too. Like, I know that's more of our story. You start out as lenders, and you get comfortable with the risks, and you say, well, shoot, we could become equity investors. So it can go both ways. Well, how about you, Andrew? So how did you sort of get into the real estate biz and lending? And I know you got an interesting background as well, and sort of a learned man, a trained attorney, law school guy.
Well, yeah, actually, that's how Ruben and I met. We went to law school together. Kind of just kept in touch ever since. But yeah, that's how I would describe the journey starting. In 2012, I was in law school studying real estate law, and I was like, hey, I really like this. Like, I could probably do this. And I went on to become a managing director at a commercial real estate finance brokerage in Manhattan. And from there, I just like did transactions nationwide, really just got a good idea of what it takes to get various types of deals done, and just got like a really wide range of experience. And then from there, I joined up forces with our good friend Ruben here.
So it's funny because he and I, we went to, like he said, law school together, and we thought we were going to be the best attorneys in the world and the whole nine. And long and behold, we find each other at a conference where I was speaking on the panel, and I'm like, "What are you doing here?" And he asked me the same question, and turns out we both went into this space, and we kept in touch ever since. He was sending us deals, and we were working very well together, and thankfully we were able to not only work together on that front, but also now partner up to bring Wheeland to newer heights.
Yeah, that's great. I mean, I think it is, if even for me, when I was a kid growing up, I mean, it's sort of what you think, well, you go to law school to practice law. And maybe that is sort of what everyone thinks as they're in it, but it is interesting. I mean, it's a great thing to do, even if you don't intend on practicing law, right? Like it's an invaluable sort of educational experience, is it not? I mean, like it trains you how to think and how to process and to be more logical and how to write, and things that are really, really important skills, especially to be a better business person, to read contracts, all those things that can trip you up. So, I myself went to college and forgot to actually go to class. I thought it was a big part of it. And I realized it's not for me, but hey, if I could redo it, maybe I would have went to law school or something. Maybe I actually would have, probably not, but
there's still time.
We were talking amongst ourselves, and I said, I'll do it all over again. Although I know I'm not practicing today, and maybe sometime in the near future, you never know. I mean, I never knew that I was going to be entering the private lending space. You never know. I might just end up, entering into the legal space, but I would do it all over again because of what you said. It really changes the way you think, the way you look at things. You look at, the risks more than you do look at the rewards. And that has helped us tremendously on this front to kind of foresee the not only the good, but specifically the bad. And then of course, be able to build up the fort to withstand all that can happen that goes wrong. Yeah. So that's definitely helpful.
And I think it's a good segue too into what you guys are doing now, because really, you're a nationwide lender. I mean, so you've, a lot of people in the space, they sort of come in, and it's a little more boutique-y, right? Like, you set up shop and you're a hard money lender, and this sort of like right here, this sort of 50 square miles or whatever it is, right? Like, we're lending money here. But for you guys, and this is what I've heard from our other clients over the years, is just that the difficulty in sort of expanding nationwide for lenders, it really has a lot to do with just the fact that because you've got different states and different, it goes back to the sort of this legal overhead that kind of comes along with it. And let's face it, not everybody has been trained or has sort of the intellectual horsepower, I call it, right, to sort of be comfortable navigating those things, right? It's too many moving parts. So maybe you guys can speak to that as like, that decision to sort of be more than just sort of your local or regional lender, but really to sort of build this platform that is WeLend to be, much more nationwide. I know you don't lend in every state yet, but you lend in a lot of states.
Absolutely. And look, I mean, it definitely comes with its own risk. And the question is, how do you hedge it, right? So for us, the biggest concern is our counterparties, and just making sure that there's a trust level component involved with working with them. I mean, today, we highly depend on the people that we work with, whether it's AMCs or construction management companies. Specifically today, we're predominantly in the Eastern Corridor, New York, New Jersey, Connecticut, Pennsylvania, Florida, the Carolinas, and so on. That helped us kind of navigate through that market and have a better understanding of what's a good loan from a bad loan, and what's a good price for a property versus a bad price. But moving into other states and trying to focus and build your bandwidth there, the only way to do that is by having the right people in the right places. So it's something that we've been kind of working to develop and improve on, and it's worked well. It's worked well to date. So it's definitely something that we're very grateful for.
And I think what I'd like to add is that there's a lot of precautions that we put in place. We're not just lending nationwide willy-nilly. We generally don't lend in rural areas. If we do, I'll be at 50 LTV.
Yeah.
And we're just very selective about the locations and sponsors that we move forward with. I think one thing we always look for is to see that the sponsor's done this type of deal in this market numerous times. That's the type of sponsor that we work with and that we're comfortable with.
Absolutely. I mean, it all really comes down to the underwriting as well, right? You want to make sure that you're making the right loan at the right numbers and leverages and so on, and making it to the right sponsor. For us, majority of our business today is coming from returning business. So we feel comfortable in the sponsors or borrowers execution, because they've done it before and we have a track record of them doing it. So it definitely helps us kind of hedge the risks of going into markets that we're not, all too familiar with as we are here, say in New York and New Jersey.
Yeah, no, I mean, it's, and that's where, I mean, obviously that's my big passion project as well. It's just the notion of the vetting sponsors and ensuring that, because when people are, I mean, whether you're borrowing the money or whether you're, that's just all, it's a capital stack issue, right? Am I senior in the capital stack? Am I in a mezz piece, or am I investing as an equity investor? I mean, obviously it matters to all of those parties. And I think that sometimes, there's, obviously leverage obviously is what allows most projects to sort of pencil and make sense. You need leverage. And I think from an equity investor's perspective, seeing who that lender is, I think it's sort of an overlooked thing. I don't think that everyone fully appreciates that, right? So if someone is able to go out, now I don't think it should be the only thing that you use as an equity investor to decide whether or not you should invest in some syndicated real estate, but knowing that in order for them to get that debt, that project had to go and cross Andrew and Ruben's desk right first. And you can look to the reputation too of the senior lender as a data point on a given project. Who's the one providing the debt, is sort of a thing that you can look to. But I think that who the sponsor is, what is the business plan, all those things, they matter just the same obviously to the senior lender like you guys, as they should to the equity investors. And so and then it goes back to that track record. And so for me, these are the things I heard over and over and over again. It's just this whole thing, track record comes up in every conversation you have, but then I'm going, who's the one that's actually figuring out whether or not these track records are legitimate or not? Right? And obviously if you've lent money to them before and you got it back, then you sort of go, okay, yeah, our version of your track record, that's good. But how do you guys deal with that?
Sure. So we'll pull entity documents from the borrower's entities that they've done previous deals with. We want to see the actual legal documents. It happens where a borrower comes in, says that they have all the experience in the world, and then when it comes down to seeing that in writing, it doesn't necessarily exist.
It's funny that we're even talking about this. Right before this, we had our report management meeting with our data scientist who brings us the reports, and we kind of analyze some of the data that we have. And we're looking at the data specifically for experience, and a lot of the borrowers that come to us originally say, hey, we have all this experience on the Sun. We've done 10 similar projects in the past, but once our verification process kicks in, out of that 10 deals that they promised or alleged that they've done, only about 3 or 4 of them are actually verified.
Yeah.
So, every borrower, and we appreciate that, because sometimes they just may not have some of the documents that we need to confirm or verify that they had the experience. I mean, when my brothers and I were buying properties, truthfully, sometimes we were buying properties and wiring them money, they would buy it. We had no documents executed amongst each other. It's just family and the whole nine. So I can appreciate that. Yeah. But from our perspective, we won't know that unless we have documents verifying it and we have a way to get to that end result. So other than the documents that we're looking at from the borrower, we're also going on different websites and online just to make sure that information does check out to the best ability. New York here has an amazing platform where you can actually go ahead and verify who were the signatories on a loan, who actually was the signatory on the the deed and so on. So it definitely helps. New Jersey has the same. So it definitely helps us get through that underwriting as we need to.
Yeah. No, and it's so funny to hear you guys share that because it's the same experience we have. I mean, that since we've launched our sort of track record verification service, it's the same thing, right? Like, yeah, we got all this experience, all these things, and then you sort of whittle it down and you're like, okay, whether it is like you said, Ruben, hey, it was deals that you did with your brother, your family, or whatever, and you didn't document it. I mean, that's a big part of it. And then just other things are sort of like, they're remembering, they misremember things, right? Like, okay, yeah, you're right. I was only an LP on that deal, or whatever the case may be, right? So
I think to take that one step further, I mean, not only taking a close look at their like track record, but we have to take a really close look at the borrower himself or herself.
Yeah.
So we have to do a full background check on the borrower to ensure that they haven't committed fraud, that they haven't had a bankruptcy, that they don't have a foreclosure,
Money laundering. I mean, it's just a number of things.
Yeah.
I think just with our like legal background, we look at everything from a liability perspective. So we want to check every box to ensure that we have no liability when we're issuing these loans.
We see the risk before we see the reward, and that's in one view it's a good thing, and in a different view, an entrepreneurial view, it's not the best thing, right? So, but it definitely helps us kind of mitigate the risks and the exposure.
Yeah, well, and that's why I say that it you see it a lot where guys who were active investors and developers and themselves. And that's why I say, like, when you look at your experience, Ruben, in particular, just like having done that and then having gone to law school and, went through that whole thing, and then you become a lender. I mean, it allows you to do that. And that's what lenders should be doing, right? You've got to be looking at the downside risk because, your upside is capped. It's capped at the rate of interest that you're going to collect, right? So, whereas, but the ability then to see potentially the vision that the borrower has or what they see and be able to go there. I mean, let's face it. I mean, this is sort of the demise of banks and lending in general, is that bankers they'd have none of the things. I mean, all they do is they're just check boxes. I mean, I know I don't need to be disparaging, but it's not surprising to me that they've lost any foothold they had on lending, right? Or that lending in general has become such, I mean, in comparison to what it used to be, a very small part of what they've done. Now, the good news, and as a capitalist and a free markets guy and a believer in the private sector, I think that it's clearly working. It's working better than it did before. Having private parties being able to go in and become lenders is just working better. I think it's better for the country. There's more progress, more things get done. And it's because of this. Right. But when you think about it, to do what you guys are doing now, 25 years ago, it would have been really tough sledding. Right. And that's why we call it hard money. Like, hard money then was sort of also, it was lender of last resort. Like, it was this guy's probably going to default and we're going to take the property back type of lending.
And that's how they viewed it. They looked at it from a perspective of, lend to own. If I lend on this, would I be okay to own it? And look, I mean, I've borrowed from these type of hard money lenders in the past when I was, still very active in my projects. And there's look, from their perspective, there's nothing wrong with it. It makes sense for them. But you're right. I mean, now that we have all this institutional capital coming in, it definitely has improved the industry for the better, no doubt about it.
And also, I would say one major difference today, as opposed to 25 years ago, we're using technology in basically every aspect of our business to extract data, to add various sort of
improvements.
Yeah, what's the word I'm looking for? Automations.
Yeah.
We're adding so many different automations to where previously we had 10 people doing something. Now we have software and 1 or 2 people doing the same thing.
Yeah.
So it's just a different day and age today. It's a different game. And if you're not keeping up with these evolutions in technology and in data extraction, then you probably won't be able to keep up.
you hit it right on the head. I mean, look, in 2019, we did a significant amount of loans, and we had a head count on the back processing and underwriting side of about, I would say, 12 people, 13 people, give or take. Today, we're doing the same volume with half the head count. And we contribute that today really specifically to the technology and the automations that we were able to build into our process. It's definitely improved it, not only for purposes of reducing the head count, but also to make sure that the errors are minimized, and things are done the right way.
Yeah, no, it is. I mean, that's a big part of also, to continue to kick the bankers while they're down here. But it's that speed to make a decision, right? So before, I mean, you go round and round and round, and it's like 3 months later they decide. Well, people don't have the time, and so this is where, to your point, you guys have figured out how to cut do the same amount of volume with half the heads using technology, and it's ultimately it's consumer fate. It's saying, and not to mention, because there's competitive forces, right? Like, and this is why I'm a free market guy. Like, it's good for everybody. We all need to be pushed. We need to have competition. So it's like, you guys either figure out how to process information faster to get you access to information you need to make a sound decision, whether to do the loan or not. And you give them a yay or a nay, and and get the loan done. And if you can do that repeatedly, you can add additional value. You can make fast decisions that are good decisions. Borrowers will keep coming back, which is what you guys said, right? It's the repeat borrower thing. It's a lot easier. It's like in any other business. It's easier to sell an existing client something over and over and over again than it is to go and have to find a net new person to sell them to. It just, that's how it works.
And it's a lot more cost effective. No doubt about it.
Yeah, there's no doubt about it. So kind of shifting gears a little bit in terms of just what you guys look for, I guess, sort of we'll call it the property types and the kinds of loans that you want to do. I guess just maybe give us sort of that thumbnail sketch of what that looks like. Is it multifamily value add stuff, or what is sort of the typical sort of loans that you're making?
Sure. So I think that while a lot of other lenders were exposed on office, retail, and other commercial asset types pre-COVID, we were doing, and we're still doing, just residential multifamily. And having that hyper focus on where somebody's living has just helped us weather the storm. And that's where we see literally billions and billions of dollars in institutional capital pouring into. The typical like CMBS market is basically seized up. There's a couple deals here and there being done, but that capital is really pouring into our space now because we proved ourselves during COVID.
Yeah. So the translation on that is that, so this stuff is, so you've got it making amount to bridge loans on multifamily. And you're saying, when you say institutional capital, you're talking about the fact that there's the securitizations that you can actually sell this paper upstream and they'll fund it. And obviously they're going to securitize. Is that what you're kind of speaking to, where the institutional capital comes in? Or
securitization is just one strategy used by institutions to move the paper around, if you will, to move the loans around. Just because it's institutional grade paper doesn't necessarily mean that it's going to lead to a securitization. That institutional paper could be held on balance sheet, for example. But to get to your question regarding the exact type of loans on residential multifamily that we do, there's 3 types of loans that we do. So we'll do your bridge loan, 12 months on both residential multifamily. Value add only. We want to see that there's upside in the loan that we do. The next type of loan that we'll do is a long-term 30-year product. Again, both for residential and multifamily. So you've acquired the asset, you've repositioned it, and instead of selling it, you decide you want to keep it. We'll give you a 30-year loan, fixed rate at in about the 4% to 5% range, which is very competitive with banks. And that's another force that we feel is helping erode the banking industry's traditional foothold on the lending sector.
Mhm.
The third type of loan that we do, besides for our bridge and our 30-year product, is a ground up program, which we only work with highly experienced sponsors on that product, just to know that they have done it before, they'll do it again. But I guess long story short, in layman's terms, in English, we only lend on residential and multifamily because those are the most safe and secure asset types historically, and we believe moving forward.
So I'm assuming then on that 30-year product, so that's investment property only. I mean, it's residential, multifamily, and then is it on a one-off basis, or is that like where you're doing deals where it like could be a pool of assets, and like who's funding those? I mean, so you get competitive rates of 5 or 6%. So are you guys in more of like a correspondent relationship at that point, where like where does that paper land? Is it in some warehouse line that you then sell to once again to an institutional investor?
So we fund the 30-year loans, and they're all sold because we can't have loans of that length on our balance sheet. It just doesn't work for the numbers. But it ends up with very large institutions.
Yeah, so they like that, and then whatever they're doing, that's where it might get securitized or whatever. At that point, it's not your. I mean, do you guys get to keep like some kind of spread on? I mean, nothing. It's just like you sell it at a premium and it's gone.
So no, usually we get to keep a spread, thankfully, and that helps us with enhancing the returns. But not only trading the paper helps us enhance the returns, but also levering the capital that we have. I mean, it's essentially that's what it all really comes down to. Thankfully today, majority of what we're doing is like you said, kind of working with institutions that help us lever the capital that we have from the family that we were able to raise from.
Yeah. Yes, I mean, that seems like then that's that focus of that particular property type is certainly what also aids in just making it easier to sort of originate loans in broader geographies. Right. I mean, it's because if you do try to do like we're doing office and we're doing like all those other things, that requires like different skill sets internally, and it just right, it just creates
it helps focusing on what we know best and being able to continue improving on it. When you go into a number of different asset classes that you yourself personally are not familiar with, it definitely throws wrenches in the pot and kind of complicates things.
I think one of my favorite sayings from a mentor of mine is that as a residential or multifamily landlord, if you lose one tenant, the next month you go ahead and you rent out that unit. As a commercial landlord, if you lose one tenant, you lose your shirt.
Yeah, exactly. It's like, oh boy. Yeah, there's a lot more people to backfill, and it goes to your point too on just the rural, so you're lending in markets that don't have as much depth, right? There's not as many bodies, or humans to backfill and to come in and lease that property or whatever the case may be. So just sticking with areas that people want to be in. And yeah, I mean, that's obviously the benefit of multifamily is that even in that case, if one person moves out, even if it's only for a month downtime, it's sort of spread. You get the diversification of multiple doors, multiple tenants.
It definitely helps.
Yeah. So you guys then, I mean, as far as, post, I mean, it sounds like you got a pretty robust sort of underwriting, how you go about sort of deciding whether to make that loan, vetting the borrower, obviously vetting the property, arriving at value, what's your advance rate, those things. So, but how about post, like after you make the loan? I mean, are there any things you guys sort of do to, I mean, obviously the name of the game is that you just want those payments to keep showing up. So are there extra little things that you guys do to sort of tip the scales in your favor that'll indeed continue to happen?
Yeah, of course. So we're super active on social media. We want to be everywhere all the time. Besides for that, so if it's one of our borrowers' birthdays, we'll send them a happy birthday email. We like to pay attention to little details like that. Additionally, when one of our borrowers who took a fix and flip or a bridge loan, when their loans coming due over the next few months, we'll give them a call and offer them a 30-year refinance. That way we can try to be an all-in-one shop for our borrowers.
But aside from that, I mean, look, for our borrowers, especially the ones that are buying value add properties, their number one concern is the construction draws. They want to get that as fast as possible, and as less painful as possible. So what we're trying to do is educate them on our draw process. Let them know, look, this is what the process is like. This is what we need. This is what we expect. And don't call us the day that you need the construction draw. Call us a few days prior, especially if it's outside of New York and New Jersey. We want to make sure that our counterparties are getting there in time, getting those inspections completed, and getting those reports to us as soon as we can. So we always try to educate our borrowers. But aside from that, I mean, we have borrowers that are always stumbling across some type of issue. I mean, you know it yourself. You're always, what you expect doesn't always turn out exactly how you expect it. Yes. So essentially what we're trying to do is educate them and provide them the resources that they need, right? We ourselves, we've seen a lot of the pitfalls that our borrowers are coming across. So for us, the value add for them from us is being able to educate them and make the introductions that they need to make sure that they get exactly what they expect in a timeline that was expected.
Yeah. Yeah, it makes a lot of sense. I mean, and so I'm assuming then that's what you guys have contemplated as you do execute your expansion strategy then too, is that how can we, knowing that, I mean, because what I'm hearing is that that's sort of additional value add. That's differentiation for the borrowers, is that we're not just the money, we're actually a resource and can help connect you with people to help ensure that you execute successfully to the degree that we can. So, how do you deal with that as that expansion does take place, to develop those relationships of the same type in the markets that you're maybe not necessarily, grew up in, so to speak, or operating out of?
Good point. I mean, look, podcasts like this make a lot of sense and help us in making the right connections and creating the network that we need. Today, with the technology that we have, to find the right people in the right places, I wouldn't say is easy, but is definitely easier. But aside from that, I mean, we're always traveling. Well, obviously after COVID, but pre-COVID, we were always traveling, making sure that we're meeting the right people to have in our network to be able to make those introductions. Today, like we said, majority of our business is in the areas that we know best, in the areas where we have the network that we need to be able to bring that value add to our borrowers. But as we're continuing to grow into other states, we recognize that those states are growing. And for us, the focus kind of transitions into those states to make sure that we're building that pool and that nest that we absolutely need.
Yeah, no, makes sense. So sort of wrapping it up here, but I'm always curious, like, what's the one loan that you wish you could take, that you made, that you wish you could take back? That of course on the surface seemed like, this is good. But then you're like, man, we should have never done that deal. Have you had one of those? We had a handful of them, and they were just like, it just, they brand on you. You're like, you never forget them.
They happen way too often, not too often, but they happen, right? And the key really is learning from those mistakes. One of them that I would say was a loan that I wish I'd never done is when there's a number of wholesalers involved. When you see that, red flags for us right away. It's something that we thankfully learned from, but also we're able to walk out unscathed from.
And why do you say that? What do wholesalers represent? Is it like transfer of title issues, or it's just sort of like it's this hot potato? Like, I mean, I don't really even understand what that would mean.
You hit it right on the head. I mean, it was a transfer of title issue, right? So, when there's a number of wholesalers involved, there was another buyer that came around, said that he had the right to buy the property versus our ultimate borrower. It was a little bit of an issue, but thankfully it was resolved. The title claim kicked in, and we were repaid down to the penny. And that's what it really comes down to.
Yeah. That makes sense. Yeah. It's just that, and that's what I think. I mean, obviously as a lender, you you know that these title issues, I don't know if the average person fully appreciates that title risk. I mean, obviously, a title insurance and these sort of things, but like it is the way that it gets done. When you think about it, it's pretty crazy and like very complicated and sort of, I mean, it's old school, right? Like it got to go down to the county and all this sort of stuff, and like it's crazy.
You don't really realize the value of title insurance until you need them to kick in, especially to our borrowers, right? I mean, there's some borrowers who are always complaining on all the title costs or what have you, but when the problem arises, I mean, you're thankful that you were able to choose the right title company and underwrite it to be able to back you on issues of this type.
Yeah, definitely. Cool. All right. Well, where can people learn more about WeLend, and whether you're looking to borrow money or you're looking to potentially allocate some capital? Where can people find you guys?
Yeah, so we're on all major social media platforms, including TikTok, believe it or not. You can find us on our handle at WeLend LLC. You can also visit our website at www.welendllc.com.
Awesome. Cool. Well, as always, fellas, I always enjoy our time together. Thank you so much. I appreciate it.
Thanks for having us, Lance.
All right. Take care.